Hi, this is James Kundasamy from Achieve Investment Group. Today, we're going to be doing an educational webinar, just primarily for passive investors, and I'm happy to do this webinars. And today's topic is going to be 2023. How are you going to be protecting your equity during these uncertain times? And I think I had a mistake here, typo here. Let me just take this off. With Jeremy Roll, who's one of my good friend. And Jeremy is a well-known speaker, and I'm going to be introducing him in a short while, but let me just quickly introduce myself and Shanti, who's my wife and a partner. So I'm the CEO of Achieve Investment Group. In case you all do not know us, family responsible for acquisition and investor relationship. And Shanti runs the property and construction management. We are deal sponsor out of Austin, where we focus on both Austin to San Antonio I-35 corridor. We have done more than 0.5 billion asset under management, more than around 4,000 units right now, 19 apartments. We had like almost sold half of our asset last year in March of 2022, which was a really good time. We raised almost $81 million from our investor base. Right now, we're working on ground-up constructions. We have like almost 1,000 units under development with around 300 something under construction. And we also vertically integrated asset, property management, and construction management, primarily on the development side. We don't do the actual general construction of the asset. We usually hire a GC for that. I'm also author of 2 best-selling books, which is Passive Investing in Commercial Real Estate. It's a very popular book. If you not read that book yet, you should, because a lot of things that's happening right now in the market. I wrote about it in 2019 when the book was published, primarily about bridge loans and when you should be taking that kind of loans. Bridge loans inherently comes with variable rate loan, and it was clearly mentioned in that book. And I think maybe like 4 to 5 months ago, I launched another book, which is called Smarter Doctors, primarily for doctors. And I know I didn't promote that book a lot, but that book is out there. And if you are in the medical profession, or if you have anybody who are in the medical profession who want to know about passive investing, that'd be a really good book. And also we have a large Facebook group, which has like almost 20,000 members. If you want to join, it's called a Multifamily Investors Group in Facebook. You should join us. Our newsletter is being read by almost 5,000 people per week. So you should definitely join our newsletter. Just go to achieveinvestmentgroup.com and sign up into our newsletter, achieveinvestmentgroup.com. So without delay, I'm going to introduce Jeremy Roll, who's a sought-after speaker in a lot of conferences. And he has graciously willing to share his knowledge of passive investing. He's a huge investor. He has invested for many years, and I'm going to be passing over the baton to him right now. So Jeremy, let me make sure I'm able to promote you as a host, then you can continue your presentation.
All right. Am I good to go?
Yeah, go ahead.
Great. Okay. Let me just try sharing my screen. Give me a second, everybody.
Yeah, I just want to make sure everybody understands. So this is a webinar, but we also will be packaging it as a podcast. So I will be asking questions to Jeremy throughout the presentation so that it's not one-way street. And if you have any questions, just use the Q&A box and type it in. And as I said, Jeremy is a very well-known passive investor. In fact, I call him like a super passive investor. You know, he's super conservative and he knows a lot of industry out there. So go ahead, Jeremy.
Yeah, James, thanks for having me on. I appreciate it. Thanks for everyone who's joining us here, who's listening to this through the podcast. My name's Jeremy Roll. I am a full-time passive cash flow investor. I've been investing in alternative investments. It started with actually real estate, and I've done a lot of other things too. Back in 2002, so over 20 years ago. And but I've been investing full-time as a passive investor since 2007, so over 15 years ago now. For today, we're going to be talking about protecting your equity in uncertain times, strategies for today's challenging investing environment. And to say that today is challenging is probably a significant understatement. I know you guys a lot of you already know this, but I've had multiple conversations this week alone on the phone when somebody says to me, well, what makes sense right now? What are you investing in? And my answer is very straightforward. I say, okay, we're in June of 2023. Let me pretend it's June of 2008. What do you think is a good investment right now? And then the phone goes silent. And that's kind of how I feel like we are today. And so you have to be very, very careful right now. Very high probability that we're going to be facing a recession later this year or early next year, based on a lot of data. And so there's a lot of challenges potentially coming up. We're going to get a little bit more into that as I get into the presentation here. And I'm probably going to do about 20 to 30 minutes of a presentation. And then I would strongly encourage and welcome any Q&A whatsoever. It could be an ask me anything type situation or regarding the presentation itself. Any way that I can help anybody out there, just feel free to ask questions, not a problem. I'm a very big proponent of Q&A just to help as much as I can. So first very important point is I am not a financial advisor or investment advisor. I'm also not an accountant or attorney or anything else. And so this presentation reflects solely my perspective as an investor. It's not to be taken as investment advice. James asked me to come on here and just kind of present what I think is happening right now, what to watch out for. And that's what I'm doing, but I'm definitely not a financial advisor, investment advisor. This is not financial advice. So I went into my background a little bit. So we talked about the fact that I've been a passive cash flow investor for over 20 years, since 2002, full-time since 2007, so over 15 years. I also manage a private group of over 1,000 investors. I started that back in 2002 as well. I'm co-founder of a nonprofit called For Investors by Investors. That was co-founded in 2007. And those are public investor meetings, mostly in Southern California, with the absolute core philosophy of no sales pitch. That's why we co-founded it. We actually lose money off of that every year, but hopefully we help, the community and stuff to learn. So that's been going on for over 15 years. I'm also been an advisor for a well-known real estate crowdfunding website called RealtyMogul that some of you have probably heard of. I was actually their only outside advisor who wasn't an investor. I started with them before they launched in 2012. And in fact, little known fact is that the first few deals that they had posted, it was just me and the two co-founders at underwriting them. And then they created an investment committee. I was part of that for a number of years. And I haven't done really much formal advisory for them for a while, but I still have that relationship with them. Also have an MBA from the Wharton School, and I didn't put it down here, but I did have over 10 years of experience in lower and middle level management positions in the corporate world before I became a full-time passive cash flow investor. The two last companies I worked for were Toyota headquarters, the car company in Los Angeles, as well as Disney headquarters, which I'm sure most people know that brand, obviously, in Burbank, California. I'm heavily diversified as a strategy because I tend to be pretty low risk, as James had mentioned. So I'm currently invested in over 60 LLCs actively right now, and I've been in more than 150 to 200 LLCs since 2002. Left the corporate world in 2007 thanks to the passive cash flow. And so I'm very heavily cash flow focused, pretty low risk, and typically looking for stuff that's, let's say, 80 to 100% occupied, stabilized, with the philosophy that I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So I'm all about predictability of cash flow. And that's an important thing to understand. So when you're thinking about this presentation and you're listening to it from me, just keep in mind that I only invest in that type of box. Whereas there's 1,000 ways to invest, and none of them are wrong. Some people invest in only high risk development, other type things. That's fine. That just whatever makes the most sense for each person. But my presentation is coming in from my angle of being a lower risk passive cash flow investor.
Yeah.
So
I think Jeremy, and that's good that you explained that, because I think in my book, I also talk about when someone is young, they can always take some risk, in going for high appreciation, low cash flow deals. Whereas when you are more, when you're more risk averse, later part of life where you want that cash flow, right? You want to go for cash flow, lower risk kind of deal, right? So it looks like, and you explained to yourself saying that why you're investing in cash flow, right? So
that's exactly right. Yeah. And so I'm a big believer there's 1,000 ways to invest. None of them are wrong. It's really a question of whatever's optimal for the person and whatever makes sense for that particular person. So, why am I focused on protecting my equity right now? So let's actually rewind a little bit the past few years. So 2020, we had a pandemic and a stock market crash that was very quickly propped up by record money printing, record quantitative easing, and other pandemic measures that I know you're all familiar with: eviction moratoriums, foreclosure forbearances, stimulus, all kinds of stuff. 2021, we had record money printing and quantitative easing, which pulled forward consumer demand and increased asset prices. It did both of those, right? It very much impacted the economy and very much impacted asset prices together. And so 2021 was what I call the year of the tailwinds for investors, right? It was just, you could almost do nothing wrong in that particular year, just a lot of money chasing deals and a lot of things going upwards. 2022, the stimulus and pandemic measures ended. Consumer savings reverted back to pre-pandemic levels. And the consumer demand that we talked about before that was pulled forward had been very much spent and is now mostly behind us. So depending on which data you read or believe, there was about $3 trillion of excess stimulus money that got into the hands of consumers specifically. Most measures now, or most data shows that the majority of that money is now spent. We probably have somewhere in the midst of a $0.5 trillion to $1 trillion of the $3 trillion left. What's interesting too is that if you parse out how it's left and who it's left for, most of the lower and middle income households have now fully spent it, whereas some of the remaining is in the upper middle and upper income households that still have it. So that's interesting to consider too, but most of it will likely be fully spent by, call it this fall. And then of course, the Fed ended quantitative easing, started quantitative tightening, and raised interest rates significantly last year in 2022. Interest rates first increase occurred in March of 2022. It's important to understand that multiple interest rate increases almost always increase cap rates, cause a recession, and reduce asset prices. And we've seen a little bit of this happen so far. We've seen increased cap rates, but because of increased interest rates. Now, we'll get into a little bit more detail later, but I don't think we've seen the full increase in cap rates because I don't think the cap rates have increased in as far as to reflect what returns are required by investors. We're going to get into that a little bit later, but they have increased in response to cap rates. And often, or most of the time, multiple interest rate increases cause a recession. Now, based on a lot of indicators, most people are expecting a recession sometime in the second half of this year or early 2024. That's very high probability. Of course, anything can happen, but I always like speaking in probabilities because that's how I think in terms of where's the highest probable scenario for me to watch out for. And multiple interest rate increases almost always reduce asset prices. We've seen a reduction in asset prices in multifamily specifically, depending on which data you read or believe. We've seen reductions of 20 to 25% in multifamily prices. What hasn't happened yet is keep in mind that when you have a recession, usually rents go down. And when rents go down, especially in an inflationary period for expenses continuing to go up, you have stagflation, which means that you actually have a lower profit or NOI on a building. And when that happens, your asset prices reduce even at the same cap rate or multiple because of the fact that your profits are lower. So we've seen a couple dominoes fall, but a couple of dominoes still haven't quite fallen yet that are likely and probable to fall later this year or early next year. So 2022 was what I call the year of the headwinds. So 2021, year of the tailwinds, 2022, year of the headwinds. And 2023, which we're in right now, is the year of asset price reductions and a possible recession. So the Fed continues with quantitative tightening and raising interest rates. As everybody I'm sure knows here, the Fed paused their interest rate increases earlier. I think it was this week, unless I'm losing track of my weeks. The summer is, but they did hint that right now their most probable scenario is 2 more 25 basis point interest rate increases based on surveying all the Fed members. So we should expect at the moment continued interest rate increases going into the second half of the year. And sorry about this 15 to 20% here. I didn't update that data, but the latest data is showing 20 to 25% multifamily decreases, likely have further to go. Cap rates continue to increase, asset prices continue to increase, and a recession is likely coming up in the second half of the year. Now, as you know, another major challenge right now is inflation. And government published inflation is about 5% right now. But real inflation is significantly higher. For those of you who aren't familiar with this, the government very regularly changes the way it calculates inflation. And part of the reason why they do that is to try to keep the inflation measures the most precise possible as far as reflecting what society is spending money on in a given time period compared to the past. But, if you take a look at how they used to measure inflation pre-1982 when they started to make these changes, real inflation is running at about 9 to 10% plus. And you can actually find this calculated for you at a website called shadowstats.com. Again, it's shadowstats with an S.com, where they show the pre-1982 calculation, the current calculation. And so the reason why I'm mentioning all this is, what is the real inflation number? I'm not sure any of us really know. But if you assume it's over 5% and maybe somewhere between 5 and 9 or 10%, then as an investor, one of your main goals should be to not fall behind on inflation, and in fact, to stay ahead of inflation, right? So that you're actually growing the real value of your capital and not having it reduce. So it's very important to keep your eye on what is real inflation, what returns do you really need to target compared to what's published to make sure you're staying ahead and not falling behind. Something to consider. So a big risk for real estate in 2023 is inflation. If expense inflation exceeds revenue inflation, then NOI decreases and the property value decreases. Now, that's what I mentioned before about what happens if we have rents go down due to a recession, for example, which is actually currently probable, and expenses to continue to go up. And we've actually seen in some multifamily markets, like Phoenix, for example, rents already going down. The rents are already going down in certain cities. And so this is already starting. But a recession will likely make it more widespread and possibly worse where it's already starting to go down. So this is something to keep an eye on. I would say that my number one concern of what people are not watching in multifamily right now is the likelihood that we will have a decrease in rents if we have a recession. I feel like right now everyone's focused on challenges associated with floating rate bridge loans, which makes sense because I know that's a very real challenge for a lot of people. But I don't hear anybody talking about what happens when rents come down, because that's actually the probable scenario right now if you believe that the highest probability is a recession. So
yeah, so Jeremy, just me add that. So that's the only saving grace right now for multifamily, right? So a lot of people did bridge loan for the past 2 years because that's the only way people can do deals, right? So the only saving grace for all not all, a lot of people who had the bridge loan is like, hey, the rents has not come down, right? That's the only positive thing. And if you're saying there's a possibility that's come down, then there's going to be a lot of domino effect there.
I fully agree. That's actually why I'm taking the time to specifically point it out. I think the two things you're going to find as themes in 2023 in the second half are recession and rents coming down and NOIs going down. Those are things that people haven't been talking about that much yet, but I think they're both unfortunately going to happen.
But why do you think there's a possibility of rents coming down?
Because if you take a look historically, what happens in a recession, rents come down. And actually, they come down across all asset classes. And I'm making a generalization, right? There are obviously going to be exceptions. There are going to be exceptional markets. There are going to be exceptional properties. There are going to be some properties that were so under market rents to begin with, maybe they don't have to adjust. So there's a lot of exceptions. I'm just making a generalization. But when people say, multifamily rents won't go down because everyone always needs a place to live, and there's a shortage of units and all this stuff, right? The statistics show that we're short 5 million units or whatever the numbers are. My response to it is, this is what happens in a recession. This is the typical dominoes that fall. You have people losing their jobs and they can't afford to pay the rent, or they have getting reduced hours and they can afford to pay less rent. And what happens subsequently is a few different things. First is some people may lose their job, go back and live at home, and they leave their apartment unit. Some people will either lose their job or perhaps get a reduction in hours and then take on a roommate. Well, where's that roommate coming from that's rooming with them to pay the rent? They may be coming from another apartment building, and that person has left that apartment building, right? Some people will take a step down in quality of asset type. So they may go from a Class C multifamily building to a mobile home park if they need to. They may go from a Class B to a Class C, a Class A to a Class B. That again results in additional vacancies depending on which building you're in, right? And so this is the normal course of action that happens and the normal course of dominoes that happen in a recession. Now, I can't predict exactly what's going to happen. I'm just going with what's historically happened and extrapolating that into the future. So I can't tell you this definitively, but I'm going with the most probable scenario. Does that make sense, James?
Yeah, so I think in 2008, I mean, a lot of times, I mean, when multifamily, from what I heard from people have gone through that, is the household formation become very little, right? People start having roommates. That's the biggest possibility, right? But don't you think I mean, right now, if you look at the national average, buying versus renting, right? I mean, it's like $1,000 different, right? If people want to go and buy a house just because the rates are so high, they pay $1,000 more. So don't you think renting would still be a preferred method of living in a sheltered place, right? So I think the only thing what you're saying is people might just drop a class, I guess, from A class to B class and B to C and maybe C to mobile home park, I guess.
I do think people will drop classes. I think people will group up and live together. And I think some people will go live back home. And I think all three of those scenarios result in higher vacancy for multifamily.
So what about the job market that has been, strong until now? And what
Yeah.
about soft landing that the Fed or some
Yes.
people are talking about?
Yes. So here's what's interesting about the job market. Statistically, and it's actually mind-boggling to me that you don't ever hear about this in the media, because the media likes to talk about the fact that job market's still strong because I guess it's selling eyeballs. But statistically, from the first month that the Fed starts to raise interest rates at the end of a cycle, it takes 18 months on average for job losses to really start in a meaningful way. So what does that mean for us now? The first interest rate increase was in March of 2022. I personally was never expecting, and I continue to not expect, job losses to get significantly worse. They're just starting to tick up in the last 2 weeks. It's just starting now, but I never expected jobs to get any worse until the fall of this year, because that's the probability of what we should expect. So if you want to get rid of all the media and all the other noise you're hearing and just look at the data, that's actually what's to be expected. So that nothing is out of the ordinary at the moment.
Yeah, and also a lot of layoff in the tech job, right? I mean, a lot of tech people, they get like 6 months, 8 months of severance package, right? And they are not being reflected right now in the losses right now because of that package. So all that's gonna come out soon, I guess, because all that getting expired, right? All that being used up, so it will be
That is
reflected.
100% true. That's another factor. And also the ratio of open jobs to people looking for jobs, I believe, is currently 1.6 to 1, and it came down from about 2 to 1 at the peak. But once those people you just mentioned are going to come off the sidelines, off their severance, and start to really kind of take a job because they have to versus what they're trying to find optimally, that ratio is going to start to really shrink. And that's going to happen at the exact same time, James, to your point, as job losses start to actually get much worse in every other industry, because it's really only the tech that had huge layoffs. That was offset by still a strong job market in other sectors, but that's now, we're at the end of all that. So I'm fully expecting the job market to get worse, and so is Powell in the second half of the year, because that's actually what you should expect from a probability perspective.
What about the liquidity crunch that the Fed is talking about in terms of the bank lending? I mean, because
Yes.
because of bank
Yes.
failures and liquidity crunch, I'm already seeing it right now. A lot of banks have not want to lend anymore, right?
Yes. So I think that we saw the impact of that very quickly in real estate, because the whole real estate piece, especially in the office side and some multifamily as well, was seeing distressed very early on and quickly, and the banks saw that very quickly. But here's what's interesting. Again, statistically, the first liquidity event tightening began in March of 2023 with a couple of the banks failing. Now, what you would normally expect once liquidity starts to tighten is that it would take 6 to 12 months for the full liquidity challenge to actually impact the market. And I'm talking about not just for real estate, but also for small businesses, et cetera, right? So we still haven't seen the full impact of that lack of liquidity yet in either real estate or in small business. And that should get worse in about 3 to 9 months from now. That should be like the peak of challenge of liquidity. And so, interestingly enough, what's fascinating is that you start layering all these challenges together, right? Rents coming down, job losses going up, liquidity getting worse. It's all at the same timing. And I'm pretty sure Powell knows that that's actually coming up. And I'm pretty sure that's why, like, there might be 1 or 2 little more interest rate hikes, but he knows it's all going to really hit everything. And so when you add all this up, James, all of this happening together, the probability of a soft landing is very low. I believe the Fed has only had a couple of soft landings in the past 50 plus years. So on a percentage probability basis, the probability is very high that we'll have a non-soft landing looking at all the previous cycles.
Yeah, the couple with the track record of Fed always messes up, right? It's very hard to get everything right? So
that's right. It's just hard to get it right. And then when you look at the fact that we had so much excess liquidity and so much excess inflation in this particular situation right now that was manufactured because of the money printing, that increases the probability of a harder landing because you're having to revert to the mean. And it's when you're going up so much, you got to come down a lot to revert to the mean. And that is increasing the probability of a hard landing.
yeah, got that. Yeah, let's go ahead.
So, okay, so just to finish out this slide. So I talked about before that with inflation, like we talked about earlier, if expense inflation exceeds revenue inflation, then NOI decreases and the property value decreases, right? But if NOI decreases and the cap rates increase, right? Because we have people losing jobs. By the way, just so you know, the stock market, one more thing everybody should keep in mind in the future now. The stock market doesn't normally crash until after the Fed starts to cut interest rates. I'm going to repeat that again. The stock market does not crash in a downturn, usually until after the Fed starts to decrease or cut interest rates. So everybody's talking about the stock market looking great, soft landing, it's still high. This is actually all normal. This is a normal progression of the dominoes falling, right? And so it'd be abnormal if the stock market would have crashed by now. But keep in mind that that time will come as most likely. And when it does, that'll breed more fear for investors, less liquidity in the market, both in terms of banks and lending, but also even equity investors and debt investors, frankly. That will have cap rates most likely go up, right? Because people will be scared and the risk premiums will change. And that will likely create a compounding effect on property values. And just to be clear about that, what I mean by that is that you have rents coming down, expenses going up, net operating income going down. Okay, so that's one way the value of the building goes down. And then you have cap rates going up at the exact same time for those other reasons. And now you have a compounding effect on property values decreasing further. So you have two different forces compounding on each other to make properties go down, property values go down. So this is actually all the highest probability scenario at the moment, just based on how a downturn, a recession happens. So stuff you have to be very, very careful with if you're trying to protect your equity.
Yeah. I think the other factor that I want to just add in is, I mean, past, 5 years, 6 years, there's a lot of people who jumped into the multifamily bandwagon, right? So, and a lot of operators are new, right? And they have never seen values going down or rents going down. They only experience rents going up, right? Because past 10 years, everything has been going up. Cap rate is compressing, people doubling their money and everybody celebrate as though they did the work, right? But now it's going to be really hard if you do not know how to asset manage a property when NOI is decreasing, right? How do you reduce expenses? So the experience level of the players, especially, on the syndication side, it's going to be causing, some issues, right? So, that's going to be a big thing that I see right now. A lot of, even I can see right now with the cash flowing disappearing because the rates goes up. It's being helped by the rate cap that they bought, but a lot of people just do not know how to manage the asset, right? They were hoping the property management company is going to do a great job, but how if the if the market is going against them, right? It's really hard to manage. So a lot of people are really hoping that things will change once the Fed start cutting rates. But are you saying that when the Fed start cutting rate, the stock market? There's data that shows stock market may crash at that point of time.
Right.
And
so when you look at that's right. When you look at a normal cycle, you don't expect the stock market to fully crash until the Fed starts to lower rates. And the reason why that is because the Fed will not be lowering rates unless there is a major problem with the economy to the point where it's absolutely necessary. And this happens not just in an inflationary period, but in normal times as well. And that's when the stock market is then seeing, okay, things are really hitting the fan. And, that's when you get your big plunge. So yes, James, I stressed that before because I don't think a lot of people realize that, but if you just look it up, if you look that up, you'll see what I'm talking about. Yeah,
and also, if you read the Howard Marks book, right, Mastering the Market Cycle, right? The true definition of a down market is not like I mean, right now everybody is waiting. I mean, there's a lot of talk about in town saying that, oh, prices are going to come down. Let's go and we are all going to go and buy great deals out there. But there's a lot of people talking about the same thing. But that's not a true definition of a down market. A down market is when you can't really execute any purchase, right? For some reason, either there's no liquidity or there's no capital or stock market crashed and everybody's scared, right? That's a true definition of a down market, right? That's where the best deals are, but it's going to be very hard for a lot of people to execute at that point of time. And that's when the real down market is. That's when the best deals are. But who can execute it at that point of time is it's going to gain, but it's going to be really hard to execute because
yes, I agree with you 100%. That's what I was kind of alluding to before, James, which is that, you know, we're not at peak fear. We're not at peak of liquidity problems yet. We're not. And both of those are what's going to basically breed the best opportunities. So we're not there yet. We're just not there yet.
Yeah, and I see a lot of misuse of Warren Buffett's theme, right? Buy when others are fear, and sell when people are greedy. I mean, that's completely misused code at the wrong time.
Yeah. So with this slide here, we already touched upon these points. So I want to be clear. What I'm most concerned about right now is because I invest in stuff that's mostly stabilized and doesn't have a huge value add component to it normally, I have to be very careful in the value that I go into the asset at, right? Because I'm not going to expect a huge increase in value in the asset going forward based on the business plan and the way that I invest. And so keeping that in mind, my biggest concern is now investing in an asset that might be worth less than 6 or 12 months from now for the reasons we discussed. So to me, my primary concern for 2023 is asset values are at risk, and therefore, how do I protect my equity and how do I avoid that type of challenge? But at the same time, staying in cash is not a good solution, as inflation is rampant and reducing the value of cash every day, which I know a lot of you know. So in order to mitigate these risks right now in terms of challenging timing, keeping cash not being productive and being eaten away by inflation, my solution is basically to be focused on 3 different types of investments while I wait for more clarity about asset prices, a potential recession, and until the current headwinds subside. And so the 3 categories of investments I'm looking at, I'm going to get into each one of these in more detail in the coming slides, are unique investments with unusual pricing or significant built-in equity up front. And the purpose of that is to build in what I call padding on the buy, so that if prices or asset prices do go down a little bit more from here, that you've actually already built in that padding and protected yourself from that possibility of prices going further down. Number 2 is investments in which I don't have to worry about asset prices decreasing. I'm going to get into that in a more detail. That'll make a little more sense when I get into that section. And number 3 is short-term investments that have relatively low risk instead of staying in cash due to inflation. So let's talk about that first one. And so unique investments with unusual pricing or significant built-in equity up front. So as I mentioned before, the whole purpose of this category is to protect myself from downside risk of asset prices decreasing. So there's no doubt that, like multifamily, long-term, there's a lot of asset classes that are very attractive, right? As far as long-run, predictable cash flow. But in the short term and the current timing is challenging because asset prices are decreasing, will likely experience further price declines. So the challenge is to find opportunities today with unusual pricing or with significant equity built in upfront, so you can actually move forward on them today instead of having to wait until the prices fully adjust. I'll give you an example of what I've been doing a lot of in the past 2 years or so in the multifamily space. In fact, as I should have mentioned up front, I did not invest in one multifamily bridge loan opportunity. And that was for many reasons, including the risk of, interest rates adjusting because it's not as predictable as a fixed rate loan. So I was investing in 2020, 21, and 22 in tax abated opportunities. So they're hard to find, but what's interesting about them is that they have considerable built-in equity at closing. And that's actually without any operational execution risk at the initial closing. So what a tax abated opportunity is, in very high level and very quickly, is an operator is buying what a regular deal under contract one big important point about it is that it will be significantly under market rents, and not just what an operator is saying, but actually really under market rents. And then they will have had a pre-negotiated structure, an agreement with the local housing authority, so that they can convert half of the building into income restricted units and keep half of the building in regular market rate units. I'm giving you an example. These percentages can vary, et cetera, but this is what I typically see. So that you now have rent restricted, half the units become rent restricted. Now, what's interesting about the rent restrictions is that they're typically guided by inflation. And it's not like this is rent control like, here in Los Angeles, where, you can't increase more than 2%, 3% a year. No, it's actually based off of those housing authority published rent increase allowances. And so there are actually deals I'm in that have scheduled for 11% rent increases next year based off inflation that are rent restricted. So don't confuse rent control with rent restricted. They're two different things. And so, but you don't have control over the amount you're allowed to raise as a maximum. You can raise it less than the maximum allowable published rate, but you can't raise it more. So you can't optimize rent going forward necessarily, but you end up in a situation where half of the building is being catered to typically 80% of the area median income and 60% of the area median income, a combination of those two. And so it's not someone who's crazy low income, half of the area median income, et cetera, but it's often 60 to 80% of the area median income to qualify for those units. And the reason why it was so key that the units had to be below market rent is because the buildings, there is a maximum published rent that's allowed to begin with. But when you buy a building that's significantly below market rents and you convert it to the structure, if it's below market rents enough, you won't have to actually reduce the rents to conform to the maximum rent amounts. And so the holy grail is to obviously convert a building where you don't have to reduce rents at that point because it already conforms to the maximum allowable rent amounts. And so long story short, when you convert buildings into this type of structure, you often reduce your taxes by the equivalent of about 85% reduction in taxes, which is equivalent to about, this says 20% reduction in expenses, actually about a 40% reduction in expenses. And yeah, some of my numbers up here, based on what I've seen recently versus what I originally wrote, are a little bit off. But bottom line is that you reduce the expenses by typically 40%. Now, what happens when you reduce the expenses but don't have to reduce the income? The value of the building at initial closing is significantly higher. And what I've seen as an investor is that, let's say you're investing $100 million purchase, $30 million in equity, $70 million in debt. Often the $30 million in equity, the $100 million value, it appraises at somewhere between $125 million and $150 million at initial closing because of the reduced expense ratio. And that means that the $30 million of equity that's invested is not only worth the $30 million of equity, which would mean the $100 million purchase price, but additional 25 to 50 million in equity at closing right away, okay, before you've even purchased the building. So what that does, from my perspective, is build in a tremendous amount of padding in case asset prices decrease. I look at it as a downside risk measure as opposed to like, oh, I just got a ton of equity built in without any operational execution risk thus far. I actually, that's great, but I'm more defensive. So it's all about the padding in case that asset price decreases in the next 6 to 12 months. I'm still in a very padded situation. So, that was one example of, how do you invest in something with kind of unique pricing, unique profile today to create that padding up front to protect against asset prices decreasing. Second category is investments that where I don't have to worry about asset prices decreasing. And I know that sounds a little strange, especially for real estate investors, but just bear with me here. So there are some investment types outside of real estate where you don't have to worry about asset prices decreasing because they're already going to decrease anyway. So, for example, I've been investing in ATM machines, those, the cash machines, not the bank brands, but the kind of independent brands at the, mom and pop hair salon, nail shop, et cetera, since 2008. And I've done really well with them. And what are they? They're essentially a case, a screen, a keypad, a bill feeder. This is all computer components. What happens to computers? They depreciate to almost zero. We all know that. So I'm already expecting the assets to depreciate to almost zero. What I care about in this scenario is not what the asset value is going to be worth, but the predictability of cash flow in general, but also especially during a recession. And I started investing in ATMs in January of 2008, went through the last recession and saw that they tend to perform pretty well with very little revenue reduction in my previous experience in a recession. So I continue to invest in ATMs at the moment with the probability that they'll perform well in a recession based on my own experience. And I don't worry about whether the asset price is, whether the machine's worth even less during a recession, because that's not what this is about. This is about hopefully a good cash flow stream that will continue during a downturn and continue throughout the life of the machine. And so this is another way to invest as an example where you don't have to worry about the asset price decreasing in the coming months. It's all about that cash flow that you're looking for. And the third category that we talked, yes.
Just to add that, I mean, we gave an offering to our investors last year, December, first time for ATM machine, and it was very well received by our investor base just because of the cash flow it predicts, and until now it has been very predictable. Every 26th of the month, we get cash flow, but 24.7% of whatever we invested. That's awesome. And looking at the IRR, it's like 19% IRR, right? I mean, over 7 years, and it's just hard to get that kind of IRR investment. And IRR is the ultimate investment metrics, right? I know there's many people looking at investment metrics differently, but for me, IRR is the ultimate, measurement.
Yes, for sure, for sure. So the third category, and we're almost done with all this, is how do you keep up with inflation while you're maintaining low risk and maintaining some decent liquidity? A lot of people choose money market accounts. I've chosen U.S. Treasuries. And the reason why I've done that, and you don't really hear people talking about this very much, is money market accounts definitely have liquidity, or at least that's what they're marketed to have. They have more liquidity than U.S. Treasuries in that theoretically you can pull your money out at any time. A Treasury you'd have to go resell on an open market. But what I'm concerned about with money market accounts, which no one has talked about, is take a look at how the banks have failed. They basically had short-term obligations and long-term locked-in investments, and they couldn't bridge the gap because interest rates went up, their long-term investments, their bonds went down, and they couldn't liquidate those for high enough value quickly enough. What happens when you invest in a money market fund that has relatively short-term investments? I don't know what those are. You'd have to research them. Some may be 3 months, 6 months, a year, whatever they are. And interest rates continue to go up. Those assets actually go down in value, just like the bank assets went down in value. And if there is, for some reason, a rush to get money out of the money market account with assets that are worth less at a time when interest rates are going up, assets are worth less, they're going to have the exact same liquidity problem that banks had. Now, do I really think that's going to happen? Is there going to be a big rush of people out of money market accounts or money market funds? Low probability, I think. But I think it's higher risk than U.S. Treasuries when you own a Treasury directly yourself that you control and can just buy and sell. And of course, I have the same risk with U.S. Treasuries of the value going up and down, but I can control owning very low short-term Treasuries, and I can also ladder them. So what I do is I buy Treasury with 3 to 4 months remaining on them. And these, I actually just bought some this week, and I think they were like a 5.32% yield. And what I've been doing since last summer is what's called laddering. So meaning that I actually buy Treasuries every week or two, and then in order to have liquidity come up very often. So I did that for several months, got all my money working, and now I have Treasuries coming up almost every week or two, and I can either take that liquidity in full and keep it in cash, or I can reinvest it into more Treasuries, which is what I've chosen to do today. So instead of me having to go and like rush to the door and sell Treasuries if I need liquidity, usually I only have to wait a week or two, and I have a pretty good chunk of Treasuries coming due, or to get that full liquidity without taking any loss, especially if they're worth less because interest rates went up. Interestingly enough, if they went down, if interest rates go down, the Treasuries become worth more, and then I can actually proactively choose to sell or choose to take the liquidity early with the gain if I want to. So that's what I've chosen to do for myself for now. Keep in mind that Treasuries are also state tax exempt. Sorry, they're that's actually incorrect. I believe they're federally tax exempt sorry, they're either state or federally tax exempt. I always get it confused, but they're tax exempt from one or the other, and I can't recall which it is. So just a quick recap, and then we're going to get into some Q&A. So 2020 and 21 were the years of stimulus and tailwinds. 22 is a year of tightening and headwinds. 23 is a year of asset price decreases and a possible, and I would say likely probable recession. Multiple interest rate increases, quantitative tightening, and an inverted yield curve will likely result in a recession during the second half of 2023, if not perhaps early in 24. That's from a probability perspective. But inflation is rampant. So as investors, we still need to deploy our capital to avoid falling behind due to inflation. Do not be stagnant right now, or you will fall behind, especially in this type of inflationary environment. So these are the solutions that I am doing myself. So again, use unique investments with unusual pricing or significant built-in equity up front to mitigate a possible reduction in asset prices coming up. Investments in which I don't have to worry about asset prices decreasing, or short-term investments that have relatively low risk and have some good liquidity like treasuries. But the solution for you and not for me is to devise an investment that conforms to the current investment environment, but also makes sense for you and your comfort level, like we talked about at the beginning. And my investment types may not be a fit for you. These are just examples of what I'm doing, but make sure that you're not just listening to this and just doing that. You're actually doing whatever makes sense for you based on your own comfort level, strategy, etc. And the right solution for you allows you to deploy your capital in the face of inflation with the possibility asset value decreasing and an upcoming recession. So just keep all that in mind. So that's all I've got for everybody today, just in terms of food for thought. Hopefully this was helpful. You've got my email on that slide. You're welcome to reach out to me anytime for any reason. Happy to help. And we can go on to the Q&A, James, if you'd like.
Yeah, let's do that. So we'll be ending the webinar exactly at 8 o'clock Central. So let's go to Q&A. So can you recommend some sources to get news that are more rational than mainstream TRP rating based bust?
I'll mention a few sources that I use right now real quick. First one that I like, but just be very careful. It has a very negative slant. You have to there's a lot of conspiracy theory stuff on it. It's by Wall Street guys. They started in 2009 after the last downturn, just to try to get out of the weeds of the media and help people learn what's going on with the real data. It's called zerohedge.com. So zerohedge.com. Again, a lot of conspiracy theory stuff, but if you just keep to reading only the data, the Wall Street, articles, etc., they tend to be quite good and tend to help you to understand in advance what might be coming up. Another one that I really like, well, we talked about shadowstats.com to see the real inflation data. And another one I really like, just for pure data, not much commentary, not too much of a bias either way, is calculatedriskblog.com. So calculatedriskblog.com. They tend to just take government release data, put it into charts, look at all the historical charts. So if you want to see CPI for the last few years, and just look at it on a chart and see it without too much commentary and not have to read about opinions about it, it's a really good place to go. They tend to archive a lot of charts that they track themselves.
Okay, the next question is, if you want to educate yourself on macroeconomics, can you recommend some books or courses?
Boy, that's a good question. I do not have specific courses or books. And what I would say is, I'm going to rattle off a couple of good YouTube channels, I think, but they're more slanted towards real estate, but definitely discuss a lot about the economy at the same time. So one of them, so some of you might be familiar with Ken McElroy. He's a well-known multifamily investor. He's been investing over 20 years. He has a really good YouTube channel. I think he keeps a very level head and is very honest about his opinions, and he also follows the economy. Another is James Eng, ENG. He is a partner at the largest multifamily mortgage broker in Texas, and he has really great macro information and multifamily information on his YouTube channel. Those are two really good channels, somewhat for what you're asking, not perfect, but definitely some stuff to watch. I unfortunately don't really have any courses or anything specific on the macro side. I'm sorry.
Yeah, I think I would recommend Mastering the Market Cycle by Howard Marks. That's a really good book. It talks about how people behave during ups and downs of market and how to identify the bottom of the market at the same time, identify the top of the market. It's all about human behaviors. And
Yeah,
really,
can I actually, James, let me throw one more in, but this is very high level, but really good to understand high level cycles and stuff. Ray Dalio, he's been spending a lot of time. So Bridgewater, he founded Bridgewater, which is the largest hedge fund in the world. He recently, I think, kind of semi-retired from it, but he spent a lot of time creating content recently, and he wrote a couple books as well that talks about how cycles happen, how empires, increase and fall, like the US dollar. A lot of really good stuff from a very high macro perspective.
So on top of that, do you think the US dollar is at risk not being a global currency?
Well, reading Ray Dalio stuff is much better than my opinion. I will say this, that every empire falls. We're right about in the time of the cycle where that would be beginning. There's a lot of very specific events happening, wars, arguments with China, Russia, etc., that are all signs that we're starting to decline. That transition typically takes 10 to 20 years. It's a slow decline. Our debt levels are also a very big indicator that that's happening. So we're going through the normal progress, like of how an empire grows and falls. It's all normal stuff. It's all happened many times before. So it's actually fairly predictable. I do think that we're getting towards the tail end of that. It's impossible to know the timing. So if you ask me, I'd be surprised if in 30 or 40 years from now, we were still the reserve currency. But it's a question, is it going to be 10 years, 20 years, 30 years? I'm not sure.
Got it. Next question is, I know we talked about multifamily, but so all your contacts on this presentation, is it just multifamily or just including other CRE asset class like hospitality, hotels, and other commercial?
Yeah, good question. I kept it to multifamily for most of my thoughts today, just to try to make it relevant for the audience, because I know we were focused on multifamily. I would say this: revenues decline across most, if not all, asset classes as a generalization, not just multifamily during a recession. So a lot of what we talked about applies to all the different asset classes, but each one will be impacted differently. A very quick example, retail, for example, which I have investments in. You can argue that because of the internet and stuff, that took its real deep dive of valuation and cap rates probably in 2015, 16, 17, and has been pretty stable since then. And is therefore, because it's been less volatile in the past few years and hasn't had the run up, it's less likely to have major run down at the same time too, right? So each asset class is going to have its unique properties.
Yeah, I think the Green State published, right, saying that the office is one of the worst performing asset class right now, just because of the work from home phenomena, and also the banks are stopping to lend, and that might cause a domino effect to the office sector. Correct. So what about single family homes? What do you think is going to happen?
So single family homes are actually also very predictable in terms of affordability levels. You reach an affordability peak. There's a lot of data behind what you can research to see when we hit a peak. I can speak to California because I live here and I track this. In California, based off historical cycles, we peaked at a 17% affordability in 2022. That's normally the final peaking point. That's actually the exact peaking point. We hit that exact number. So the peak in California was last year. I think that we've already had some price adjustment here. Theoretically, prices should reduce in the next 18 months or so, but probably less so than a normal downturn, because of the fact that there's a lot of people locked into their interest rates from a supply perspective. And so what has to happen in order for a cycle to reset is for affordability to reset. But if affordability can't reset because we're not going to have enough supply side to bring the prices down as much as normal, then the way that occurs as an alternative is for prices to go sideways for many years, so that wages and inflation catch up with the affordability. And that's more likely more probable scenario right now for this cycle. Probably a little bit more decrease in price in the next year or so during a recession, et cetera, and then sideways for longer in order for the affordability to reset and for inflation and stuff to erode the value of the properties enough to reach the equilibrium for affordability.
Yeah, I'm gonna select. We have 6 more minutes. I'm gonna start selecting some questions, and we'll answer.
We can go over a couple minutes. I just unfortunately have an event that I have to be at very shortly.
I understand. So we really appreciate you coming and sharing. How do you track all your investments, since you have like around 60 different passive investments?
Yeah, it's a very, very boring answer. I have a very big spreadsheet. that I have broken out by month for projected cash flow. Every time I invest in something new, I add a row, I add it on, I add when the projected cash flow is going to come in, and I compare what I'm getting each quarter, whatever it is in cash flow, to what was projected, just to see the variances. But it's really just a very rudimentary spreadsheet. There are definitely online tools and software that I've seen over time, especially in the last few years, been a few of them introduced that can help you to do that in probably a cleaner way, but it's not something that I do.
So I think there's some recent Blackstone Bitcoin ETF news, and do you invest in Bitcoin as well after this news?
The only Bitcoin exposure I have is as a diversification. I thought Bitcoin was going to go down a couple of years ago, but I thought it was like an end of cycle phenomenon, which is kind of what happened. But I did actually decide to get some exposure in case I was wrong for diversification into Bitcoin mining, because Bitcoin mining had less downside risk, but had less upside available as well. And so I am in a Bitcoin mining fund that's cash flowing right now. But I don't track Bitcoin very closely, and it was just a diversification measure for me.
Got it. How do you hold ownership in your passive investments? Is it just like a simple passive investment ownership?
Yeah, my ownership is held personally. So there's no LLC, et cetera. We can get into this in more detail, but theoretically, if the LLC you're investing into is structured correctly, the legal documents are done correctly, you're typically limited to your original investment, as far as no one can force you to put more money in a typical correct structure. And your liability is limited. The liability is all on the more active members, which is typically the general partners. So I've asked a lot of attorneys and accountants over the years. I've never found any benefit from what I can understand. And again, I'm not an accountant or attorney, but that's what I've concluded as to doing anything beyond just investing personally.
So what type of IRR do you want to see before you start investing into multifamily?
Yeah. So historically, I'm a very big proponent of cash flow. So I focus a lot on cash flow. And what ends up happening is that based off the cash flow levels I typically target, in the past, I've been able to back into about a 15% IRR, give or take, in the stuff that I typically invest in. The challenge with that question right now is that we're having an end of cycle reset. And so you really won't know what the new cycle will bring until it starts. And realistically, so I can't give you a good idea of what that's going to look like in the next 12 to 24 months in terms of answering a more current, up-to-date answer, because that's going to be dictated by the market and what I can find as an investor.
Yeah. Next question is, how would your investing strategy change this year if you had a large capital gains event that could be offset by bonus depreciation?
Yeah, very good question. I think that I don't like investing for tax benefits as a strategy, because then what I'm doing is I might be going outside of my typical, more predictable cash flow box to try to find something to make it work. So I'm not a good person to be giving an answer for this, because it doesn't normally, I would try to find stuff that does make sense in terms of more bonus depreciation, et cetera, but I would still pay the tax if I couldn't find the right investment, versus like making a mistake with the wrong type of investment. Because let's be clear, you can get bonus depreciation in a deal, but if that deal goes to zero, you've lost money, right? You've actually deferred some taxes for a period of time, but the overall outcome was no good. So I would caution people to be very careful investing just for tax benefits, especially if it's conforming outside of your general risk profile, and or if it's kind of being forced.
Got it. How long do you expect cap rates to continue to increase?
Yeah, that's a great question. It really depends on what the recession looks like, how scared people get, how bad we have of a downturn. There's a lot of factors, but it wouldn't surprise me if cap rates stabilized. So I would expect probably in about 12 to 24 months, we might see cap rates stabilize. I'm not saying they're going to start to, get better at that point in terms of values going up or anything, but I could see us stabilizing in the 12 to 24 month period.
Got it. Next question. A recession is somewhat tricky to generalize that will cause rent to go down. What was average drop in GDP that data showed drop in rents?
Yeah, I don't have any data handy to be able to tie GDP to property values or to rents. And also keep in mind, it totally depends on your location, your type of asset, your rent levels, et cetera. So I don't have very specifics like data I can just refer to here right now quickly, but just keep in mind that as a high level perspective, directionally, rents go down during a recession. And therefore, when rents go down in an inflationary period, when expenses are still going up, you should expect a reduction in net operating income and reduction in value of a property.
Got it. Last one. What would happen to deep value add deals that were purchased in 2022 on a bridge loans, where today they're still able to get 20% rent bump for renovated products if they can manage the expenses and if the operator is able, they're able to survive? Do you think?
Yeah. So I did not invest in any floating rate bridge loan deals, so I'm not the right person to answer this, but I have asked some people about that type of question. And here's my understanding. First things to understand, your 20% rent bumps in 2023 that you're referring to, they're about to potentially go in the wrong direction because of recession. So it's not just about what will happen this year, like right now, what you're able to get today. It's about what will happen in the next 6 to 12 months while you're completing your value add project. And then what happens to cap rates at the same time on the multiple you're going to get from the property. So there's a lot of factors at play. It's not just about what rents you're seeing today. It's about when you're going to sell that property. How does that entire picture look? And right now, that picture is facing tremendous headwinds from a probability perspective, right? Because probability is we're going to have recessions, rents are going to go down, NOI is going to go down. At the same time, cap rates are going to go up, and you're going to have that compounding effect of the value of the building going down. Will your rents be enough to offset that? Obviously, it's on a case-by-case basis. So you'd have to take a look at a lot of factors there.
Yeah, the other thing I realized is, you can go 20, 30% rent bump, but your interest rate has wiped off your rent bump, right? Because, unless you have to go into a fixed rate loan and you have a long loan term, if you're on a bridge loan and if your, rate cap is expiring or your bridge expiring and you can't really refinance into a fixed rate product, your rent bump doesn't make any difference, right? Because your interest rate is higher right now. It has wiped off all your rent increases.
Right. And that's just something I forgot to mention is that, I was told that generally speaking, the shock from the degree of interest rate increase compared to anything prior to March of 2022 was so dramatic that it's almost impossible to make up for it on rent increases. Now, the reason why I didn't mention that is because the scenario that person just mentioned was someone who got a bridge loan in 2022. And if they did it a little bit of the ways in, where there was already some adjustment in pricing, that might be a slightly different scenario than the worst case scenario of pre-March 2022, but we don't know. So
yeah, got it. And last question, single family peaking metric of 17%. If there are a lot of international buyers coming in and dumping in money, does the metric still hold good? For example, Miami has investors mostly from outside of Miami. It has been unaffordable for locals too. For a long time, yet prices keep going up.
Yeah, that's a great question. Every market's different. So I'm giving you a generalization. Each market has its own quirks. I'll tell you this though, there's always international money coming in until there isn't. Like last year, all I was hearing in the year before is that, oh, we may have, things may slow down, but there's so much liquidity and so much money, prices are never going to go down. Okay, that's what people get saying. And my answer was, there's always a lot of liquidity until there isn't because of an event. And that now it's happened, right? That event has happened. The same reason why international money comes in cycles and comes and goes and it stops. And that's because of either recession in their country or recession in this country, et cetera. So that liquidity will change. And so I would still be very careful to think that prices don't go up forever. If you believe cycles are finished and the cycles no longer exist, then your theory is probably correct. But if you believe cycles still exist, then the answer is international money will not offset a cycle and continue prices going up. There's not enough international money coming in, and it stops and has its own cycle of money coming in and coming out from an international perspective.
Awesome. Thank you so much, Jeremy, for coming and sharing your knowledge. And I think we have gone more than 4 minutes into whatever time needed. But thank you so much, and thanks for all the audience who have been staying and listening to Jeremy and myself. Thank you.
Thanks, everybody.